Well, some traders have reported a surge in demand for negative yielding bonds. The latest Bloomberg Barclays Global Aggregate Index shows that as at 30 September, the total face value of negative yielding investment grade corporate and sovereign debt jumped to $11.6 trillion. So why do investors and companies line up to guarantee a loss for their portfolios? Let's ask Martin Ackerman, who's advisory partner and investment strategist at Citadel. Martin, thanks so much for your time today. I think let's start just by explaining what a negative yielding bond is.
Good evening, Ziggy. Yes, I think what we're seeing currently, especially in the Western world, is something that, we don't even see in economic textbooks. And that's the fact of negative interest rates. So a negative yielding bond basically is guaranteeing the investor that for whatever the duration on the bond, you will actually pay the company or the government that you borrow that money to actually look after your money, and you will get a guaranteed loss or less value back in terms of face value when that bond matures. So to give you an example, in Germany, in Japan today, the 10-year bonds are trading very close to zero or just slightly negative, actually implying that anybody investing or giving money to those governments for 10 years will actually earn no interest. They will pay those governments to look after their money, and the only certainty is that you'll get back less in 10 years' time compared to what you give them today. And even worse, in Switzerland, even a 50-year bond is trading at a negative yield. So for 50 years, there's no return on those investments, but just a guaranteed loss over a 50-year period.
Besides central banks that are engaged in quantitative easing, who's buying these bonds?
Yes, I think the biggest buyer probably is central banks. So part of their quantitative easing program is to actually buy up these bonds. So by buying these bonds, you create more demand, and by creating more demand, you actually push yields lower and currently into the negative territory. That's exactly what they want. They actually want to keep rates very low and, if possible, negative, because by doing that, you totally remove the incentive for investors to save. So what they would rather want investors to do is to actually take the money and go in and look for alternatives or spend the money. I think that's really the goal from, or the objective from central banks. Because if they can increase aggregate demand through spending, then hopefully later on they can cause some inflation. Yeah. And even a little bit of inflation will help to reduce the debt levels that these governments are carrying right now. But apart from central banks, who else is buying? And that's unfortunately a lot of schemes, whether it's insurance companies or pension funds, that's got a certain mandate where they need to go and track or buy some of these bonds as part of their portfolio. Yeah. So even if yields go lower, they still, through their mandate, will need to go and buy those bonds at these kind of levels.
Do you see this phenomenon actually changing the way that trustees of these types of funds that you're talking about needing to really reevaluate what they determine to be risk then?
Yes, I do think something like that's possible, although it normally takes a lot of time, especially in Europe. If you think about it, a lot of pension funds are actually still quite heavily weighted into fixed income. Over the past couple of years, equity markets in the West struggled, and they still had quite an allocation to fixed income and bonds. And we know that bonds had quite a strong bull market as yields globally came down to all-time lows. So as we approach, which we think is probably the end of the 35-year bull market in bonds, it might take a bit of time for these governments, pension funds to reassess their policy portfolios and realize that they probably need to allocate slightly away from overweight to fixed income to some alternatives that's available.
Certainly, away from a guaranteed loss. Thanks, Martin. Martin Ackerman, advisory partner and investment strategist at Citadel.